Welcome everybody today to our November case study. Today's topic is the value of an insurance policy audit, assessing the efficiency and sustainability of existing life insurance. Before we get started, we want to just remind you we have some upcoming events. We have another case study on strategies to reward and retain key employees that will be on Tuesday, December 14th at 1 o'clock Eastern Standard Time. Kind of excited about that one. We have a specialist joining us who spent, named Bob MacArthur, spent a number of years with the Todd organization, a true specialist in deferred comp and designing reward and retain mechanisms for key employees. That should be an exciting event. And then we have after Christmas in January on the 11th, Tuesday at 1 p.m., we have our quarterly webinar on the value of understanding premium financing for your high net worth clients. A very interesting topic, really an ability for high net worth individuals to be able to procure large blocks of life insurance without any out-of-pocket cost. And we'll talk about that one in our January webinar. Before we get started, just to remind you that Strategic Lifelines is a direct resource for accountants, financial advisors, estate planning attorneys, and other tax professionals to help their high net worth and business owner clients mitigate the impact of taxes and leverage multi-generational wealth and legacy planning through the use of the most advanced tax planning strategies available under present code. Our intellectual capital guides high income and high net worth individuals to create awareness of strategies that were previously unknown to them. I'm Fran Lynch, will be one of the two speakers today, one of the managing partners of Strategic Lifelines. I'll be joined by my partner, Gene Frost. My bio is up here. In essence, I've been in the business about 16 years, made a transformation from insurance planning to adding assets under management, then benefits planning, then did fee-based planning. And over the last several years, have focused more so on working as a small business planning expert and also advanced tax planning for high net worth individuals and small business owners. Also function as a CPA team-based model consultant, where we help CPAs to be more holistic and proactive in their approach to dealing with their clients and bring more advanced tax planning strategies to the table. My partner, Gene Frost, has been in the business over 40 years, was one of the most successful managing directors of Northwestern Mutual, recruited probably more top producers than anyone that I know in the industry. Lifelong member of the $1 Million Roundtable and a specialist in benefits, employee benefits, and insurance-based planning. So before we get started today, just as a precursor, an intro to this particular topic, policy audit, I think it really opens the door. We're going to be very focused today in our conversation about auditing of life insurance policies. But the bigger issue really is that someone told me a long time ago, and I never forgot it, that planning is a dynamic process. And I think people lose sight of that. I think too many people today have what's called a set it and forget it approach. It shocks me first and foremost how few people actually have what I would call a financial quarterback, somebody that proactively is capable of looking at their entire plan relative to where they are in life, looking at all the various aspects of the plan, the legal planning, the wealth management planning, the risk management planning, the tax planning, if they have a small business, the business consulting services, and making sure that all of those particular areas of planning are optimally designed for the individual's needs at any given time. What happens for a lot of people is they'll go ahead and do some aspect of the plan, and then they stick it in the drawer and they don't think about it for a long time. And because so many people do sectorized planning, where maybe their insurance planning is done by an insurance agent and their wealth management planning is done by somebody else, wealth managers have a tendency to be pretty proactive in following up. But a lot of times people purchase insurance products from individuals that are not great at follow-up. And a lot of times situations change and those products no longer fit. I don't think there are two areas of planning that in our experience, we've seen more issues with people either outgrowing products or their situation changing. And what they have done becoming no longer appropriate for their situation than probably in estate planning and insurance planning. In the estate planning arena, people's situations change, the ownership of their asset changes, their assets grow, their children grow, and they'll sometimes do an estate plan, stick it in the drawer, and as their situation and the laws change, we find that a lot of times a plan that worked years ago will no longer work in the present environment. It's the same thing with insurance, whether insurance is being put in place for business purposes, personal purposes, or estate planning purposes. People will buy products, and what happens is their situation changes, and the products changes, the landscape changes, and we've seen this over and over. Perfect example, a small business owner that buys business overhead expense coverage to create the income to come in tax-free if they were ever to get disabled to keep their business running, will put a policy in force and then never look at it again. And then their business grows and their overhead grows, and what used to be adequate is no longer adequate. Individuals will work for a specific company and they'll go out and determine that their disability or wage protection is not adequate for their particular situation. So they'll supplement the group plan with some personally owned coverage, and then they'll switch jobs and they'll find out, or they won't find out because they haven't taken the time to look at it or don't have a proactive risk management specialist or quarterback to their financial affairs that tells them they have to look at that. The coverage is different. Maybe their income has changed and the coverage that once fit is no longer adequate. So the importance of auditing insurance policies, specifically life insurance policies, to make sure that the coverage is still commensurate with the problem that's supposed to be addressed is critical. And we really think that everybody should have a proactive specialist that they work with that will look at all aspects of their plan and make absolutely sure they're not outgrowing their products or outgrowing their services. And at any point in time, what is in place is really in line with what it is they need to protect. So as far as the policy audit analysis goes, we believe that one of the most valuable resources and services that we provide is an audit of existing life insurance policies. We've seen some major changes occur over the last decade or so. We've seen a consistent lowering of the fixed interest rates and the repricing of products, and a proper in-depth analysis can help our clients gauge if they're still on track or if there are any red flags and the policies are still competitive in the environment. In particular, and I can't overemphasize this, this exercise is extremely prudent for trustees of existing life insurance trusts, since they've assumed the fiduciary responsibility for those trusts. And it's very important that they do their due diligence, because the last thing they want to do is have a policy explode and a trust that they're a fiduciary for and find out that it's no longer going to cover the issues that they thought it was placed in force for. So the analysis exists or begins with reviewing of existing in-force policies, and it really is a win-win value proposition to the insured as well as the trustee, and it creates peace of mind that the current policies are right and they cannot be significantly improved upon. It can highlight future issues or concerns and offer a variety of options. And it's almost always an extremely useful exercise, in our opinion. In fact, I will say that when we're brought in to analyze policies, probably 7 out of 10 times, the coverage doesn't match the issue for which it was placed in force for, or the product is not right for the individual anymore. And we thought really that the best way to illustrate the point would be via several examples that highlight the benefits of this particular process. So without further ado, I'm going to bring my partner Gene in, as he's going to walk you through a couple, case studies of policies that we were brought in to do an analysis on by either a CPA or a tax attorney, or and what we have found and what we're able to accomplish. Gene, I'll turn it over to you.
Yeah, and before I get into the actual math, too, remember, too, an audit can also show if beneficiary arrangements are wrong, if ownership arrangements are wrong. It's amazing how sometimes I've been in situations where we've reviewed that which was in force and the accountant doesn't know what's going on, or the attorney doesn't know what's going on, or one of them doesn't speak to the other one. And it turns out that, you've got the wrong beneficiary or the wrong ownership or the wrong something. And that can be just as valuable as even the math, making sure it goes to who you want, when you want. And One story before we get into the case study is I called on a business owner who, second marriage, 3 kids under the, 3 kids from the first marriage. And he said, what I did is I bought a life insurance policy to leave to my kids. And he bought a $10 million policy to leave to his 3 children. And I asked him, how was it set up? And they were the beneficiaries. And no trust, anything else. Never talked to the accountant, never talked to the attorney, just bought this term policy. And I explained to him that if you died, that $10 million is going from your estate to your children, and you've just used up your entire unified credit for a term premium. And no idea that this was going on. And the premium was probably, maybe 10 grand a year, 12 grand a year. And he could have put the policy in trust and only used up the annual gift exclusion versus using up a $10 million credit against his estate. So that's an example of just maybe the policy is correct, but the process was wrong and nobody was speaking to each other. Any which way, this is an actual case we did where, years ago, we did some planning when the client had an estate of somewhere, in that $1 million range each for unified credit, $2 million each. And today, with the credit above 11 million each or $22 million, the purpose of the insurance had changed. The client really didn't need this any longer to provide liquidity, for their children. So under the original projections, the policies were designed to vanish in year 15, but with a decrease in dividend scales and crediting rates, these premiums would be paid the rest of their life. So they had bought this policy and they were not happy with the performance and its purpose had changed. And what we did was, and they were spending about $35,000 a year. What we did is we went to the insurance company, we found out what was available under exchange, and we were able to give them a $4.5 million fully paid up life policy with no further premium payments. And they freed up all those premiums for other purposes in their life. The first policy wasn't a bad deal, not a bad strategy, but it no longer served the purpose that it was designed for. I mean, the government actually changed the rules. Now they're changing it again, maybe, but they did change those rules at the time. And the client also decided, his kids were very successful. And a lot of times we do planning today and you wake up and your children want to be more successful than you. And actually, this is all nice, but it's not the reason you did it in the first place. Second case, Fran. Yeah, this is a really interesting one. The accountant actually brought us in initially to add some existing death benefit to the estate. And they were going to buy somewhere between $5 to $6 million of more insurance. And what we did is it turned out that he had 4 different policies from 4 different agents from 4 different companies. And nobody was talking to anybody. Nobody had done an illustration in years to see how they were performing. And it turned out all of them were either current assumption products or variable life products. And we did the projections. Basically, they were spending currently $90,000 a year for $8 million of coverage. And when we did the illustration under a 3% assumption, every one of these policies self-destructed prior to the client's age 85 years old. So they would continue to pay 90 grand a year. They were 70 years old, and if they didn't die in the next 15 years, there'd be no death benefit left in the estate. Well, we went to the market, we got them underwritten to see how their health was, and we were able to exchange the existing cash value and all full policies and threw them into a brand new policy, and we got them $15 million of coverage for $135,000 a year, guaranteed. And by the way, the $150 a year is what they would have to pay to keep it in force until age 100. But if anybody was alive after age 100, either of the two, that policy also lapsed under the original policies. So in every circumstance, they capped their premium, they guaranteed their death benefit, and they knew exactly what they had to pay for gifts going forward. And everybody was very, very, very pleased with the outcome. Third case, Frank. Yeah, so sometimes people buy life insurance policies for accumulation purposes. The idea is that the cash values grow, they compound tax deferred. You design policies to be very, very, very efficient, and you begin to look at what you can pull out for income during retirement. And the idea is if I put $1 in and it grows tax deferred, and I can take money out during retirement tax free, I've got an alternative asset and I've got an alternative stream of income. Well, what we were able to do in this situation by analyzing the policy, we were able to dramatically increase the income by as much as 40%, because all the companies that they were with originally weren't particularly competitive or had very high dividend crediting rates. And secondly, we were able to go back and add a long-term care access rider to these policies, which you can't add to an existing policy. So by a brand new, not only did we increase their income by 40%, we also gave an extra layer of benefits, which is these policies can provide a long-term care benefit. And that's the other thing too. A lot of times today, 20 years ago, there were probably 25 companies in the state of Connecticut that wrote standalone long-term care. There are either 2 or 3 left. I don't know the number. I don't know the number this week, but there's not very many. And the premiums have quadrupled over the last 20 years. So what's happened today is they use for a life insurance chassis, a whole life type chassis, which has a cash value to serve as a long-term care option if it should occur. So you can use your death benefit to cover your long-term care needs. Well, you can't add that to an existing policy. So Fran and I have also had cases where clients had some existing policies. Through the analysis, we were able to exchange them, get them a brand new policy, in almost all cases, give them more living benefits, cash values, and give them that long-term care access rider in addition to. So that's another thing to be aware of. So it can be done for, and another case is that Fran and I got referred to a dentist who had all sorts of real estate deals and had all these existing term policies, and every one of them was going to lapse between 12 and 15 years. And he was 55 years old. And we asked just a very simple question. Do you see yourself doing this, these deals, ongoing or stopping in 15 years? He says, no, I'll probably do this the rest of my life, or at least until I can't do it anymore. And the banks, acquired the policies to sign as collateral. Well, we went back in and rewrote all his insurance, effectively got him 20 and 25-year coverage for pretty much the same premium he was currently paying. So by shopping, sometimes we can extend the period, we can reduce premiums, we can do an awful lot of things by just auditing and seeing what's available. Next slide.
Yeah, Gene, and a corollary to that is, the second component to that is he was going through an expansion with M&A and took on a lot of debt, and he had to collaterally assign a lot of his death benefit for debt service. And literally, we looked at the situation, and if something happened to him, there was only about $250,000 of debt benefit that wasn't collaterally assigned to somebody he had debt with that would have gone to his family with 2 children. And that's a real issue, because even if you pay off the debt in the M&A, you've got somebody who's a non-dentist that can't run the practice anymore. And obviously the income stream from those particular entities are going to be significantly hampered. So there was a need, obviously, for some additional debt benefit just to cover the family until some of that debt was reduced and those collateral assignments could be reduced. So Gene, talk to them a little bit about, these are, we figured we'd give a couple examples. There's just dozens and dozens and dozens that we have uncovered. To the point that I made earlier, probably 7 out of every 10 times that we do an audit, we can improve the situation. But Gene, talk a little bit about the process, what we go through normally if somebody is interested in, in auditing their life insurance.
And let me answer the first question that wasn't asked yet. So let's pretend somebody has a client that they would like to have it audited. We don't charge a fee for the audit. We're not going to charge a fee. And we understand that sometimes we'll go through the whole audit and what they have is perfectly adequate. And we will, our job is to be a resource to accountants and attorneys as a place to call to say, I've got a problem. Can you guide me through that? So we don't charge a fee for the service. Number 2, we can go through the whole process, and sometimes the person is absolutely better off staying where they are because of age, health, or a lot of factors. And then sometimes, no matter what happens, they have an existing relationship that is very strong, but the accountant would like our advice and input to help their client, and we'll work behind the scenes. And our goal is that if there's a problem, we help solve it. The client likes us and feels comfortable, we can earn the right for that business. But please feel free to call. We'll even guide you through how to go do it yourselves if you don't want to engage us. We're a resource. We can be in the back room, we can be in the front room, whatever you guys decide, whatever anybody decides we can do. So effectively what we do obviously is first, we order current values, ownerships, and beneficiaries. We just want to make sure, what do you have and are the ownerships where you want to be? I can't tell you how many times people thought things were transferred to trusts. They never were, or you've got a key man life insurance. I had a situation where a person thought they had key man life insurance and the accountant, they bought the insurance and there was all these cash values that never replaced in the books, and the people earned them, personally. And so there's every once in a while you find some things out there. Well, how do we solve this problem? We have current in force illustrations, meaning we want to make sure that, how's the policy performing going forward? the thing about the life insurance business in industry is whatever you buy today in an illustration, unless it's a fully guaranteed premium, like a guaranteed universal life, where you pay a premium, the death benefit's guaranteed, and there is literally no cash value. The cash values fluctuate, the death benefits will fluctuate under an assumption policy. So whatever you see today within a year usually will change. Interest assumptions go up, they go down, they change. So we want to get a current illustration to make sure that this thing's going to stay in force for as long as you expect it to. And what are and how do you solve that problem if it isn't? Other current values, ownership of the policy, how is it set up? We want to run the illustration as is, exactly as it is. And then we want to make sure that if interest rates were to go down, we want to know what that looks like. What's the problem? How do we solve that problem? So we'll always ask for, usually a 1 or 2% reduction of current state. Sometimes we'll go down even 3, but whatever the client wants to do, or you would like us to run, we'll get those illustrations from the insurance company. We'll also run it if the person wants to stop paying all premiums. We also model income if it's for those assumptions. And where it gets really kind of interesting is if you buy a variable policy. And variable life is, for those of you who are aware of it, it's basically a universal life chassis to which you have a premium and a death benefit, and the underlying cash values are invested in the market. And they're called separate accounts, which are basically mutual funds, and you pick and choose those. And the goal is that you think that, that's going to outperform the general portfolio of a traditional policy. And we run it at 0, 4, 6, and 8. And what you can't do is you can't run it at a negative interest rate. You can't ever assume that you'll have a negative year. It can only be 0. So we run it at all 4 different interest rates. And when we tell our clients that if this thing is going to fall apart and not be enforced at life expectancy at 4%, we better really think about how do we manage that going forward properly, because you will be disappointed to pay all those premiums and have it fall apart in the later years, either with death benefit or cash values. Everything looks great at 10%, no matter where you put your money. It looks fantastic. It's the lower interest rates where you got to be very careful. And then if we're designing under a vanishing premium, a lot of times insurance companies will design a policy, well, I'm going to pay premiums for 10 years, and then under current assumptions, I'm going to stop paying those premiums going forward. Those, that's done under the current assumption. And what would happen if interest rates drop 1 or 2%? And so one of the things we try to do, and we recommend highly, is if you're going to design a short pay illustration, design it to be guaranteed to be done in a 10 or 12 or 15, whatever period you want it done in, design it to be done in that period, and design the policy to go fully paid up. So there are no further premium payments. So there's no unexpected future premiums unless you want the option to paying them, but not the obligation. And so that's kind of like all the things we will do, and we'll guide you through. We'll provide all the forms you want. We can go directly to the client. We can go directly through you. We're simply a resource available to help you solve these problems and to work through the policies. Anytime.
Super. Thanks, Gene. So question number 1, Gene, who's a candidate to have an insurance policy review?
I mean, I would say probably anybody who's got, a decent amount of insurance and is doing some extensive planning. Absolutely. Anybody who's got either key man life insurance or insurance inside companies or individuals in trust. I mean, I will say that for me, the ones in the trust are the first candidate, because the trust, not only do you have, the insured having an issue, making sure it's in place, but the fiduciary has a responsibility to make sure they understand the assumptions so the policy doesn't go bad. And, you always worry about, well, what happens if the beneficiaries come back and sue the trustee? So I would say that absolutely a trustee is probably the most important person, because they're a third party accepting the liability. And obviously the insured, who's doing planning wants to make sure the insurance is there for their family.
Yeah, and I'd add to that I think anybody that's had insurance in place for a number of years and hasn't looked at it, or they have bought insurance for the living benefits and the future potential income benefits that haven't looked at it in a number of years because of the change in the dynamics in the open market, should definitely be looking at these policies to have an audit. Another question. I'm sorry, Gene. Go ahead.
I was just telling a story about that. I got referred to a company that builds apartments and rents them out, and they had a policy on the dad, and the dad had a variable policy that was going to self-destruct. And to keep the policy in force, the premium was like a $5 million policy at the dad's age, who was now above 80. and obviously uninsurable was like $400,000 a year. And this policy under current assumptions was going to fall apart in the next 3 years. And they were going to lose the whole thing. And what we did is we actually turned them over to, and Fran and I are not allowed to participate, not allowed to sell it, not allowed to receive compensation, but we just explained they should call a Vatical settlement company and find out if the settlement company will buy it. And they actually were able to sell the policy. This policy would have lapsed in the next year with no insurance. And it was a $5 million death benefit. They were able to sell it to a settlement company and actually receive a check for a couple, for north of $1 million versus zero as a result of that. So sometimes we can't help them, but we can guide them in the right direction. And it's always worth the conversation. Go ahead, Fran.
Yep. I've got a client that's put a policy in force for the living benefits and future income purposes that's 5 years old. The fact that it was taken when the individual was 5 years younger, is it still possible that it could be remodeled more efficiently with another carrier?
The answer is, first of all, it's just math. So the answer is sometimes, and sometimes absolutely. It's just math, and it's such an easy thing to do. You take the existing policy, and the beauty of it is when you roll the cash value over, it goes in dollar for dollar, and it sits in the in the cash value of that policy and builds going forward. So sometimes we've been able to absolutely improve the future value of the policy in the multiple levels. There is always a break even if you have an existing policy. It might take, by moving it, it might take 5 years to where you or break even. It might take 8 or 9. I mean, usually if it's going to take more than 15, it doesn't make a lot of sense to move it because it's too far out. But yes, we've had some amazing cases where we thought that the person would probably be better off staying where they were, and they were actually far better off moving it as a result of it.
Yeah, but I'd agree with that. We've had a couple of cases actually where the policies were over a decade old, and the individual had probably still 20, 25 years before they were going to access the income for retirement benefits. And there were dramatic improvements by moving the carrier. And to the point you made, if somebody does this, what's called a 1035 exchange, it is a tax-free exchange. So it allows you to move money or cash values from policy 1 or 1 and 2 or whatever over to a new policy, and there's no tax on that exchange. That's part of the IRC. That's about it. Gene, is there anything else that you'd like to say? We try to keep these case studies. I think the one in December is going to be a little bit longer because of the complexity of the concept, but we try to keep them as short as possible. Anything else you'd like to add?
I mean, the only thing too is we've had a couple clients who bought policies a few years ago that their health wasn't great. They got slightly rated. They didn't think about reviewing anything. And sometimes, depending upon the amount, the carrier, the design, we're able to absolutely improve their cash flow. I mean, we had a client who had, basically had, $10 million of term insurance who was, rated second class. I mean, that's class 2, which is usually you have the top 3, which are select, preferred, and standard, and then you start with class 2. So he was rated 4 tables down from the best case, and we were able to go get him standard insurance with a brand new carrier and cut his premiums down by 1/3. And for term insurance, which is a pure expense, once again, it's a mathematical audit, and either A, we can help you, or B, we really can't. And it's very simple. And we tell people it's almost always worth a shot. If you can improve your lot and take, basically fill out some paper and figure out within about 10 minutes, once you get the information, what's the best place to be, it's really worth to go through the exercise.
Agreed. Well, I want to thank everybody for attending today. If you'd like to reach us, if you haven't already done so, I would strongly suggest you go to our website, www.strategiclifelines.com. There's some great information on there as to who we are and what we do, including a lot of in-depth information on the variety of different strategies that we employ. Or you can contact us via email. Our emails, our contact information is on the website. We look forward to helping anybody that might want to take a closer look at some of these policies to make absolutely sure they're designed as efficiently as possible for themselves or their clients. Again, thank you very much for joining us today. We look forward to seeing you in December for a real exciting case study on reward and retain mechanisms for highly compensated employees and key employees. Have a great day, everybody.
Bye-bye.